What's up, everyone? It's Caddy with MoneyVest. So welcome on board for another Market Open live stream. If you guys can see me, hear me, just give me a thumbs up. Just want to make sure the audio and the video is good. Happy Friday. It's the first Friday of the month of November. So today we've got the unemployment numbers coming out in less than 15 minutes. So that's going to be very, very important. It's going to give us more insight into how the labor market's holding up on the back of these higher interest rates. So once again, in the live chat, just let me know, thumbs up if the audio video is good. Just want to make sure that everything is working well. And we're ready. We're ready to see what the employment numbers are going to look like. So far, it's been incredibly strong. So, QQQs right now are slightly lower on the back of Apple earnings. I did a video earlier going over Apple. I did a video going over Fortinet. Did a video going over, multiple different companies from this past week. So it's been a very, very busy and exhaustive week. But nonetheless, we're coming in strong and closing out the week very, very strong with the markets obviously higher. The Nasdaq's up a little bit over 5% this week alone, and the S&P's up 4.89%. So today we'll find out if these results, if these, gains can hold up on the day today. So going over to some of the expectations, 170,000 jobs is the expectations for the non-farm payrolls for the month of October. So again, it's a lagging indicator. So we're getting these numbers for the previous month, and the unemployment rate is expected at around 3.8%. So coming in line with consensus, and also the prior number is 3.8%. So that's really where the expectations are. So it's slightly increased, 179,000. With private payrolls at 143,000, manufacturing payroll down 23,000, and then of course participation rates also going to be very, very important at 62.8% as well. So let's just start with a quick poll. Also, make sure that you drop a like on this live stream. I want to see at least 100 likes before the unemployment numbers come out, and let's just do a very quick poll for the unemployment numbers today. Jobless claims did tick higher just a little bit, so maybe that's something giving us a little bit of an indication that, okay, maybe there's some softening happening at the moment, but still it continues to be very, very tight. So I have no doubt in my mind that this is going to be incredibly strong once again at 3.8% unemployment rate. Of course, the closer we get to 4.2, 4.5, the bigger the problem will become eventually from a recession standpoint. So unemployment numbers, let's see, we'll do above 3.8%, at 3.8%, and then below 3.8% as well. So we'll do a quick poll. Let us know in the chat and also in the poll what you are expecting from these numbers that are coming out in now about 12 minutes. In 12 minutes, we'll get those numbers from the Bureau of Labor Statistics. They're the one that kind of measure and, of course, calculate and display and release those numbers as well. So yeah, hope you guys are doing great. It's been 215 likes so far. No way, there's nowhere near close to that number, but yes, we can definitely get there. So consensus we already went over. This is the spreadsheet that we've been tracking for unemployment. Joel's numbers came out at 9.55 million earlier this week. So, if you go over to Joel's, we came in a little bit higher than what the expectations were from the market. So they came out on Wednesday, the same day we had the Fed meeting, and 9.553 was that number, which was obviously higher than the prior number and also higher than the consensus. So that basically does suggest that, okay, there's more job openings in the US than the previous month, and that just continues to show that companies are still hiring at the moment. So this right here has been the number updated. But what I'm going to be interested in is the unemployed persons, because Jerome Powell specifically said that yes, the unemployment ratio has been slowly and steadily coming down, because this number's come down from 2.5 to 1.5, but it's still pretty elevated, meaning that it's still there's an imbalance between the demand and supply of employees, and as a result, the labor market continues to be very resilient and very strong, which again is confusing the Fed, is confusing a lot of people considering how high interest rates are, and we're still not able to see a significant amount of softening in the labor market. Companies are still hiring and putting out job offers. So that's where we are. Again, about 10 minutes left for these numbers to come out. If you have any questions, let me know in the comments, which are not related to stocks right now. We'll have plenty of time to go over individual stocks and the technical analysis. I've got another couple videos coming out later today that are, I think, going to be very, very useful in our understanding of the market technicals, the market breadth, equal weighted indexes, volatility, percentage of stocks trading above, below those moving averages. So it's going to be a super insightful video. But we'll have plenty of time to go over individual stocks because this is going to go all the way through market open. So we got a little over an hour together to go over individual stocks. But if you have any questions related to employment, inflation, interest rates, economics, happy to go over that and discuss that as well. But yeah, yields coming down. Yields this week are lower. They are down a little bit over 3%, and that's one of the reasons why we are seeing the markets as strong as they are this week. 10-year Treasury is dropping over 4% this week alone, now sitting at just over 4.6% at the moment. So we're definitely seeing, a little bit of that pullback. And if you take a look at the weekly chart, the RSI, the MACD, incredibly overbought. And I will be doing a video that goes over the five areas in the markets that are going to see significant monster rallies for when yields come down and the rates eventually do get cut. These are 5 areas of the market that are going to benefit the most from declining interest rates. I just had a deja vu right now. It's crazy. Had a deja vu of me talking about this very same thing, and talking about treasuries. It's crazy. But anyway, wow, it's still going. Anyway, treasuries definitely dropping quite aggressively this week. Now, a lot of people are saying that this is the top. We're done with it. But we have to wait and see until we get some more confirmations. And that is to say that, okay, we know the Treasury Department is still going to do about $1.5 trillion worth of issuance, right? So that's the debt that they are going to issue over the next 2 quarters. We got that refunding announcement earlier this week, which is going to be just over $700 billion in this quarter, about $800 billion next quarter, and that's going to continue to run the deficit. And if the market's demand is not as strong, of course, there's going to be more supply than demand, and prices will obviously go down, and yields will go higher because they move inversely. But right now, of course, I think there's going to be an influx. Eventually, there is going to be an influx of liquidity going into bonds because lots of investors kind of sitting on the sidelines just waiting for better and better yields because we haven't seen these levels in over 16 years, right? So if you are running a pension fund, if you're running a sovereign fund, an institutional endowment fund, right, you're looking at these yields and you're thinking to yourself, wow, 4.65% for the next 10 years if I lock it in here. But of course, the market value of those bonds can fluctuate because there's a lot of price volatility over that 10 years if the yields continue to go higher. So for that reason, lots of people, in my opinion, investors are kind of holding off, sitting on the sidelines to get better yields and better opportunities. But if we start to see yields drop, I think there will be an influx in the bond market eventually, which could lead to lower yields, which is going to be very, very strong for a lot of individual stocks, companies, and of course areas of the market that I think are going to benefit from that. So good day, everyone. Thank you so much for joining when the JOLTS data will be dropped. So it really comes down to companies, right? Companies are hiring still, which is quite interesting because, and I do think that it's going to be a little bit more skewed towards more well-capitalized companies, that are companies that have a lot of cash than debt on the balance sheet, and companies that are still growing, that are actually hiring right now. And that's for one reason why JOLTS are as high as they are. But small cap, I mean, it's completely disastrous what's happening with small cap companies. Russell 2000, I think, is down for the year. So if you come over to IWM, it is year to date down 3.4%, right? Small caps have significantly underperformed this year on the back of, not being profitable, floating rate debt, significant amounts of debt. So there are, lots of bankruptcies that are also happening in the US, right? So we did analysis on that very fact that this year could be the highest number of bankruptcies since 2010. So that's another potential catalyst for why we are seeing a significant amount of underperformance from IWM. But JOLTS numbers continues to be very strong on the back of, in my opinion, some of the larger cap tech companies, and not to mention well-capitalized companies that are still hiring at the moment. Srinivas, what is my prediction for the first 2 quarters of next year? Are they going to be bullish or bearish? So I don't like to make predictions that way. As you guys know, I really don't want to make those predictions because I know that, over time, it's not going to be, the success rate's not going to be that high when you're making predictions. I think a better question to basically ask is, what levels to really watch, right? What are the earnings going to look like? And what levels to watch, what expectations we could have for earnings, for inflation, for where interest rates could be, and then what levels to really watch on the S&P, the NASDAQ, to try to figure out the temperature of the market, right? That's what we're really doing at any given point in any given day. What we're trying to understand is, how are markets valued today, right? Are there any opportunities in this market? And I think that's a much better question than, trying to predict where the markets will be 6 months from now. Like if I tell you that, okay, markets can be at 4,800 in 6 months, it's a prediction which may or may not happen, right? But then if you look at some of the underlying data points, I think we can make better informed decisions by understanding the risk and the reward, and then also very critical areas to watch. So I have to ask you this question. If you don't want to answer, then that's fine. I'll bother you on Discord. Do you plan to open a position for Fortinet today, or you're waiting still? So sub $40 is what I would be waiting for. You guys know that I've been tracking this stock for as long as I can remember. I think it's been well over a year. I've been doing an analysis on Fortinet. So yeah, January 2023, we did come down to $46, but we never really dipped below 40, right? I mean, in October of 2022, we came down to $42, but then we rallied, 87%. And of course, from those levels, we are now back down 44%. So, staircase is up, elevator is down, 2 back-to-back earnings, weakness in guidance, and it's down over 45%. But it never really dipped below $40. It's been, the last time it was below $40 was back in May of 21. So it's been almost 2 years since it's traded below those levels. So for me, I'll wait. I mean, there's no rush. I mean, Wall Street is not rushing into this stock anytime soon. So I will patiently wait for sub $40. I think is going to be a lot more reasonable because, one of the lessons that I've learned the hard way from Enphase and from PayPal over the last 3 years is that Wall Street will completely overshoot to the downside, making stocks go from like super overvalued to like super undervalued. And they'll do that, on the back of short-term outlook. They'll do that on the back of couple quarter earnings, right? It doesn't really matter where the company is going over the next 10 years. All that matters is where the company is going over the next 2 quarters. And that's such an interesting sort of concept because I was thinking about this the other day, right? I was thinking about this particular thing literally a couple days ago where, some investors, obviously institutional investors, some of the larger investors, what they want is outperformance every single day, right? Every single year, they want outperformance, right? In other words, they want to generate a higher return than the S&P 500 every single year. But in the book, Little Book That Beats the Market, Joel Greenblatt, there's this one section that specifically says it's possible that whatever strategy you follow, right, may underperform year 1, year 2, year 3, year 4, year 5, underperforms for a long period of time, and then it finally breaks through and compensates for all the years that strategy underperformed for and more. In other words, in 10 years, you could still end up beating the market, even if you didn't beat the market in the first 9 years, right? So it's kind of like an interesting idea that, okay, institutions and large institutional funds and hedge funds and whatnot, they focus on beating the market every single year, going after stocks that are going to perform the best in that year, going to have the highest earnings growth, going to have the best results, going to show good promise of a guidance that particular year, and ditch the ones that are underperforming, whereas the ones that are ditching could actually be big winners over 5 years, 10 years out. And that's where there's this discrepancy between institution and retail. Institutions positioned for the short term. As I always say, institutions are positioned for the short term. Retail is positioned for the long term. So when we are positioned for the long term, we may have to go through a lot of price volatility in the short term because institutions at the end of the day control the market. They're the ones that are moving the market because they've got a lot of liquidity to move the market. So it's kind of like battling against two forces constantly. And obviously with institutions moving the market, by the way, employment numbers should be out now. Let's just go over them right now. We've got the QQQs right now pushing higher a little bit. And we've got the S&P 500 also up over 11 basis points. But there we go. October, 150,000. Lower, much lower than the, 3.9%. So a little bit of an increase, folks, in the number of unemployment rate. 3.9% is the number in October with 150,000 jobs added in the month of October. Now, why is that bullish, folks? Why is that bullish? Why would that be actually positive for the market? Tell me in the comments. I want to hear from every single person participating right now. Why would that actually be optimistic and more bullish for the market right now? Because we are starting to push higher a little bit. S&P is up over 26, 25 basis points. We got the NASDAQ rallying a little bit, 23, 24 basis points. We got the Dow Jones, 25 basis points. And the yields, look at the drop. 1.7% drop in the 10-year treasuries, back now under 4.6%. Yeah, so why are they good? Let me know in the comments. I want to hear from everyone. Why would that be good? So we had about 38% of folks expecting higher than 3.8%, and we did get higher than 3.8%. So we got 150,000 jobs added in the month of October, with unemployment rate ticking higher to 3.9%. So again, that's the number. This right here is the 3.9% increase, and markets are seeing that as a positive sign, pushing higher because of softening in the labor market. But I want to hear from all of you. And dual mandate achieved. Offer says, did we get the numbers? Yes, we just got the numbers. 150,000 jobs added, way below consensus, and 3.9% unemployment rate. So ticking higher than what the consensus was. So we came in hotter than the expectations for unemployment. In other words, we're weakening in the labor market. IWM ripping here. So IWM, let's take a quick look. So the small cap is up over 1%. There we go, right? Small caps significantly higher, more than the NASDAQ, right? NASDAQ's only up over 23 basis points, but small caps really pushing higher on the back of yields falling. I'll do a video. Trust me, there's a video coming out later today. You don't want to miss that. It's going to go over 5 areas of the market you really need to be looking at that are going to benefit the most from yields dropping, because the treasury yields have been going higher and higher and higher, and just putting a lot of pressure on the market, crushing expectations, and just really destroying portfolios on the back of so many different areas that have been depressed, right? And in that video, I'm going to highlight 4 to 5 areas where there could be most potential reward given the low levels of risk, considering how much yields have gone up. So if yields start to roll over, there's going to be an asymmetric risk-reward trade-offs in the future. So I'll go over that in another video. But yeah, 2 words: easing rates, bond rally, look at 10-year. So because higher unemployment than expected means that the Fed will have less likely to raise rates. Yes, exactly. You guys are absolutely right. So slowing down, then we got bad jobs data equals Fed done hiking. Absolutely correct. Fed will stop hiking, maybe even start cutting very soon. Exactly. This is exactly what the market wanted to see, right? We exactly wanted to see this, where the labor market is softening. That's what the Federal Reserve's told us, that we want to see unemployment go up. Makes me kind of wonder, like, if for the sake of Fed, that they have somewhat cooked the data to make unemployment go higher a little bit. But let's just go over to unemployed persons, which I think is going to be far more important. But this right here is the overall number. So 3.9%. This is the highest level we're seeing since January of 2022. So it's been almost a year. This is the highest number we've seen in 2023, 3.9%, by the way. But if you go to unemployed persons, hoping for at least over 6.5 million. Let's just go unemployed civilian unemployment. Let's see if we can get over 6.5 million. And we are at 6.5. We're just over 6.5. So we are just a little bit over 6.5 million. So we did get that. Let's just plug in that number. And we are looking for this ratio to now sit under 1.5. So a little bit more softening in the labor market, for the ratio being, again, JOLTS versus the unemployed persons, so job openings versus unemployed persons. Now there is less than 1.5 jobs available for every 1 person that's unemployed at the moment. So just a little bit over 6.5 million. Now let's go over to employment by industry to better understand which sectors basically gained the most. Let's see here. All right, so manufacturing did decline quite a bit. We saw 35,000 when the expectations were 23,000. So manufacturing and construction are 2 very, very important sectors for unemployment, because when you think about any economy, right, construction and manufacturing are the bare bones, the foundation of production, right? If there's no manufacturing, if there's no construction, we're not building stuff, right? Other things like trade, education, financial services, technology, like all those things continue, right, as usual. But manufacturing and construction really kind of dictates whether we're building and producing stuff or are we not. Manufacturing was down 35,000, which was way more than expectations of 23,000. And then construction actually was flat or slightly higher, 23,000. We did see a little bit of a higher number in construction. Mining and logging here, 1,000. Then we've got service providers, again, 161,000, lots of job gains there. Transportation and warehousing was also declined over 12,000. Utilities, flat. Information, financial services, somewhat lower to slightly higher. Private education and healthcare services, 89,000 jobs added. So total non-farm payrolls, 150,000, which again coming in way below expectations. Unemployment rate also ticking higher. So yields dropping pretty aggressively. That's good. 1.8% drop. We're back under 4.6% just like that with one print. And SPY here up over 0.5% with the NASDAQ also pushing up over 30 basis points. Dow Jones up 44 basis points. And IWM is up the most, 1.3%. Small caps really charging higher here on the back of dropping yields. Ash says we're celebrating the R word. Yeah, I mean, that's the unfortunate part about markets and investing in the markets. Like I mentioned this in one of my other videos when I did Palantir analysis, that it kind of somewhat sometimes makes you a little bit more shallow, and you got to like look at it from a morality standpoint as well and from an ethical standpoint. Like and as brutal as it is, like, the war benefits a lot of these companies. Like Palantir benefits from it, defense companies benefit from it. So yes, there's that aspect to investing as well. And then same thing goes true with, the markets. Like it's how the world works. I mean, recession leads to rate cuts, leads to stimulating the economy, leads to more growth and more earnings potential, which drives the market higher. So yes, we don't want this. We don't want people to lose jobs. I mean, because look, when unemployment rate goes up from 3.8 to 3.9%, that 0.1% may seem small, right? And it's just, at the end of the day, it's not numbers on a screen, right? It's not just that 0.1% increase. What really happened in that time was people did lose jobs. Unemployment did go up because people lost jobs. So yes, there is totally, that aspect of trading and investing, but it is what it is. I mean, it is how markets behave, All right, let's take a look at some comments here. Interest rates will maintain, Keith says. So how many people believe that interest rate top is in? That's what I want to know. So we're going to end this poll now. First of all, make sure that you drop a like if you're enjoying this live stream. And if you do, find it helpful, I would really appreciate that. But let's just do a quick poll. Have interest rates, have interest rates topped at 5%? This is the 10-year treasuries we're talking about, okay? 10-year yield. Yeah, the hope is that those who are unemployed will be better off in the long run because inflation will be better controlled. Yes, that is really what the Federal Reserve has been telling us, is that, if you don't control inflation today, it'll be a much bigger problem later. So that's really what they have been talking about, is that, okay, we need softening in the labor market, maybe even slow down in economic growth so that we can control inflation. Because if we don't, and if it gets entrenched in the economy, it'll be a much bigger problem later down the road. So yes, that's what the Federal Reserve's told us. Jerome Powell's told us. And let's go over to CME Watch tool to see what the Federal Reserve's expectations. I think at this point, it's going to be pretty much locked in that we're going to see a pause all the way through the rest of the year, and all the way most of next year as well. And then rate cuts towards the back half of next year. So 1, 2, 3. Three rate cuts right now priced in for the market. It may take a little bit more time for these expectations to change, but this is exactly what the market wanted to see. The market wanted to see a softening in the labor market. We got that with us hitting the highest unemployment rate in 2023 at 3.9%. Now over 6.5 million unemployed persons. So as I mentioned, 6.5, let's do 6.5 minus 6.33. So it's about 170,000 increase in the unemployed persons, and unemployment rate ticking higher to 3.9%. I also want to see what the Federal Reserve's penciled in for 2023 in their SEP for this year for unemployment. So if you go over to the projection materials, they're forecasting for unemployment to be at 3.8%. So that was actually, so that's the new projection they have, is 3.8% in 2023. This is as of September. We're going to get another SEP in December. But 3.8%, they lowered their expectations from 4.1. So we got two more employment reports coming out, one in December. Actually, we only have one more. We only have one more report coming out in December, right? Because this was just for the month of November. But we'll get another one in January, which will be for the month of December. So it'll be coming out next year, but for the previous month. So So we do have 2 more reports for 2023, but 1 more coming out in 2023. So 3.8% unemployment rate is what they're expecting. We're already sitting at 3.9. So a little bit higher than the Fed's expectation of unemployment. So they should be able to slow down now with the rate cuts. In other words, rate hikes. And we should be looking at some potential holding at these levels and maybe even rate cuts next year. Okay, so no way rates topped at 5%, Musicful says. So that's the poll going on right now. 2/3 of you actually do believe the rates have topped at 5%. 33% of you, so a third, expecting rates to not have topped at these 5% levels. When is CPI data coming out? I think it's next week. Let's take a quick look. It's going to be also BLS.gov. Consumer Price Index. The next report comes out on November 14th. So November 14th is going to be next week, right? Or no, not next week. The week after that. The week after. Yeah. Next week, I think earnings season is going to start to slow down next week, but the week after that is when inflation comes out. Dana says, honestly, I think they overdid it. Only time will tell, right? Only time will tell whether they did it appropriately or whether they overdid this, underdid it. Only time will tell. Right now, we're still seeing inflation elevated at over the Fed's target, 3.54%. Not to mention that unemployment continues to be very strong. Economy continues to be very strong as well. Joseph, no way the 10-year has topped out at 4.57 to 5% just because we have 10 years to maturity. Yeah, I mean, there's going to be some price volatility, no doubt about it, over the next 10 years. But, it really comes down to what the Federal Reserve is going to do next year if there's going to be more rate cuts. And rate cuts for the federal funds rate does affect shorter end of the curve more than the longer end. So shorter end of the curve, meaning 6 month, 3 month, 1 year. Anything that's under 1 year is what they are really controlling at the most part. But long end also does get affected. And look at the drop here, 2%. TMF is up over 2.8%. Well, on break even on this position now, almost 4.6 is where it's trading at, almost 3%. I may look to dollar cost average a little bit more into this, but like I said, I mean, it's 10-year treasuries, right? That's really what's going to control where most things go. And right now, RSI MACD obviously rolling over very, very nicely, but I may actually end up dollar cost averaging a little bit more in TMF to just as it's pushing higher, showing some signs of confirmation and moving back up. Folks, make sure that you drop a like. I would really appreciate it. 88 likes right now, so let's see if we can at least get up to over 100. Let's take a look at some individual stocks. So for example, Tesla here, 1.2%, 221 is where we are for the company. So very nice move to the upside. And let's take a look at Enphase, see how that's doing, up over 2%, so back over $80. Not bad, seeing some momentum back higher. InMode is slightly down, up 14% after the earnings yesterday. So we did get a little bit of a miss on both earnings and revenue, but they did already guide for what the earnings were going to look like. So I'll do a video on InMode here very soon. Already updated everyone in the Discord, kind of letting them know that at $19, that's the fair value if InMode can grow their free cash flows by 4%. And I think 4% is very, very reasonable. It's actually quite on the low end. And I think they can easily grow their cash flows by over 4%, right, over the next 5 years. That's not even that much if you really think about it. So I'll do a video on InMode here very soon. I think right now, next couple of days, I'm going to be focusing more on the macro and a little bit more on the technical side of things. But then, of course, we'll kind of restart some individual stock analysis for these companies as well. All right, so 69%, quite appropriate, expecting the rates to have topped at 5%. Now, of those 69%, well, I want both of these folks to participate. I wanna hear from all the 69%ers why you think the rates have topped at 5%, and the other 31% why not have the rates topped at 5%, and how high do you think they're gonna go? So we wanna hear more concrete thesis behind why you believe the rates have topped versus not topped. So let us know in the comments in the live chat, and what your thesis is. Why did you participate in that poll, and why did you vote yes versus no? So let me know. Square going ham. Let's take a look. Wow, 18% on the back of earnings here, huh? $52. EPS with a positive number, coming in with a nice beat. They reported, I think, last night, didn't they? Yeah. They reported last night along with Apple. This morning was only Fubo TV and a few other companies, but I'm sure Apple is rocketing higher right now. Right? So only down 1.3%. I feel like there's a double standard in the market. Like, if companies report a quarter like Apple, they'd be down like 10% easy. But just because it's Apple, only down 1%, right? I think there is a significant amount of bias for Apple here. So Joey says, because we have war upon us and we definitely prefer a slight inflation rather than deflation. Puneet says inflation will be sticky. Got it. Uncle says my average 550. Given how strongly the yields are dropping, 550 may not be that far off. It's about 16-17% off, so it's not that crazy. But yeah, no, I totally understand. And that's one of the things with decaying leverage ETFs, it is so important to precisely take it slow and steady, and not rush into the trade, because if you rush into it and the stock drops 20%, it just becomes that much more difficult to make that recovery, especially if you're looking at leverage ETFs, because the longer that recovery takes, the more brutal it can be. And that's not true with, of course, some of the more underlying non-levered ETFs that simply trades off of the price action, the supply demand, the support resistance. But with levered ETFs, when you have futures options in the fund, right, there's constant rollovers and you're paying a lot of fees, it can be pretty brutal. So yeah, it's very important. And that's what we have talked about in the Discord as well, right? So Kevin says, so is Santa coming or are we getting coal? The technicals do look pretty solid, I'm not going to lie, but we are still within the context of the downtrend here, lower highs and lower lows. So until we break out to the upside, there's confirmation. I think the confidence level is going to be somewhat in the middle, not overly optimistic about a breakout, not pessimistic to see a rollover and basically getting rejected and selling right back down. But right now we're kind of in the middle, coming up to that resistance. It's really going to be up to the bulls whether we get a breakout or not. If you do get a breakout, it's possible that we finish the year strongly in the next 2 months on the back of yields rolling over and falling. But yeah, it's just going to be a wait and see approach for the Nasdaq, and there will be trading opportunities. I think the market's going to give us maybe one more opportunity before the end of the year, and that's where I think the focus needs to be. It's quality over quantity. We don't need to trade every single week, every single month. We just need to find very, very good, high quality setups for the market, and look to make 20-30% on those trading windows. So. All right, the rates have topped because we see the first important signal that we are going into the recession. Unemployment starts ticking up, so it looks like the Fed might be done with rates. Inflation looks like topped at 3%. That's pretty good analysis, I would say, and a fair argument to make for the rates and why they have topped. I feel like everything is overpriced and we're going to rally from here. Not really. I wouldn't consider this overpriced. I mean, a lot of stocks have been selling off since July, right? So, I mean, if you take a look at Apple, the last 3 months, it's sold off from highs of 197 down to 11% sellout on 174. Is Apple still trading at a multiple that's expensive? Yes. I mean, 29, 30 times multiple are still pretty expensive for me. Tesla, if you take a look at since July, is down over 25-26%. Now, is Tesla's multiple also expensive? Yes. So I would make an argument that that's also pretty high. Nvidia also, I would say pretty expensive. Companies that I don't think are trading at super crazy expensive multiples are Meta, quite reasonable, despite the insane V-shaped recovery. I mean, take a look at the amount of months it's been green over here before it finally broke that streak in August. 1, 2, 3, 4, 5, 6, 7, 8, 9 consecutive months of green for Meta. Just an insane amount of rally, 256% 4%. AMD is another one that I could argue is somewhat reasonable, but of course lower the better. So $80, sub $80, really what I'm watching. And even Google. I think Google getting sold off on earnings was a big overreaction from the market. That reported phenomenal numbers on the back of such a challenging macro environment. And I think they still kind of held up really well. Awesome. Visa versus PayPal long term. PayPal is going through a bit of a transition. So it does offer somewhat of a, I would say, moderate risk to high potential reward because the upside is huge compared to the risk that it carries today based on the balance sheet and the cash flows and whatnot. Visa is a very strong moat, very profitable company. There doesn't seem to be any lingering issues at the moment with the company right now. So it depends, where you are on the risk curve. If you're looking for something that's reward potential is pretty high. I mean, between Visa and PayPal, the reward potential long term is PayPal is definitely more than Visa, but Visa is also low risk compared to PayPal. So it really depends on where you are with the risk reward. So Sean, that's a great question. What is the stock you're most interested in right now? What do you think will have the highest ROI in 5 years? So I think it's more important to look at specific sectors because in terms of stocks, a lot of it obviously depends on execution. So I believe, right, that my expectations for Tesla, Enphase are quite high over the next 5 years if execution's done well, and depends very much on the macro picture with interest rates as well. But I would much rather kind of tell you some of the themes that I think are going to be far more important over the next 5 years. Now, are these stocks going to be the ones that lead in these industries? Well, so far they are, and that just needs to continue. But I think electric vehicles, of course, solar, cybersecurity, artificial intelligence, not to mention that, and semiconductors. Like these are things that really, I think, over the next 5 years, 10 years, one needs to be. But of course, at an appropriate valuation. We just can't go out throwing money at whatever company is in those sectors, but finding opportunities within those sectors, or even looking at ETFs or index funds, because like I said, I mean, as these industries evolve, right, as they are, kind of in the early stages and they evolve, not every company in this sector is going to make it. Not every company in these industries is going to be able to survive the downturns, the higher interest rates, the mergers and acquisitions. Some of them will get acquired, some of them will go under, some of them will just not be able to execute. So there's a lot of risks as industries evolve over time. Look at the banking sector, right? I mean, it started off with over 20 or 30, 25,000 banks. Now it's been consolidated into such a small group of banks that control over 90% of the assets. And eventually that will also happen with electric vehicles. Right now, there's so many automakers, there's so many manufacturers. And in 10 years, I think there's only going to be a few that control majority of the market share. Sure, there's going to be other players, but they're not going to be as dominant as, I believe Tesla is going to be one. Ford or GM could be another, right? As they make that transition. So I think that is going to be my sort of assessment. But yeah, Tesla valuation going to be super high, no doubt about it. That's why my intrinsic value is closer to 136. Okay, so Firm says, I don't think the U.S. 10-year treasury is over 5% since Fed and government don't want to incur financial accidents like the Great Financial Crisis when yield also hovers around 5%. Yes, I think that's also a fair point because the interest on the debt is certainly going to be a big concern for from a fiscal standpoint, right? Higher interest rates, higher payments, and the deficit keeps on going on. So I totally agree there. Well, Caddy, watch your video on Endava. Unfortunately, looks like it's running away from us. Let's take a look at Endava here. 6% green yesterday. In the month, it is higher. But really just consolidating sideways. I wouldn't necessarily consider this like running away. But yeah, definitely, pretty strong company from a fundamental standpoint, like growing revenues, cash flows, earnings. And we're also running an analysis right now. It's going to be a different type of analysis, which is going to tell us the performance of a stock in a given year versus their earnings growth. So in other words, how much of a correlation there is for the stock to perform really good in that particular year with the earnings that increased on that year, because that's really where Wall Street puts all their time and energy in trying to figure out is that, oh, which company is going to have the best earnings, in this particular year, so that they're going to be the ones that rally the most. Last year, energy was the sector. This year, tech has been the sector. And next year, it's going to be something else. So that's the analysis that we're doing. So Fiverr and Upwork, your trading view is not showing pre-market. That was even higher, of course, in pre-market. Really, it's just there's no trades right now for Endava at the moment. So, but I don't doubt it. I think it's a fantastic company. So yields continue to pull back, 2.2% drop here, and the S&P and the Nasdaq pushed higher after the somewhat weakening labor market. Looks like we're gonna close this week up almost 5% or higher, and not to mention we've got inflation coming out later this month on November 14th, so that's also gonna be very important. Fiverr and Upwork, profitability is very important. In this environment, it's all going to come down to who's going to survive. That's it. Investing success long term, oftentimes it doesn't even rely very much on making a lot of decisions or making a lot of correct decisions. It relies very heavily on who's going to be in the game long enough to participate. That's it. Because investing, just general like market participation in any way, could really take capital away very, very quickly, right? So it's investing defensively that kind of keeps you in the game long term, to basically be in the best position for when the odds are in your favor. Very, very important lesson that was taught in Psychology of Money. But for Fiverr and a lot of the unprofitable companies, unfortunately, it's all going to come down to, can they survive this downturn of higher interest rates, consumer demand slowing down, and economic contraction with unemployment going higher. So there's this thing that's there's dark clouds that are appearing, right, with higher interest rates. So is it going to eventually start raining? Meaning, is it going to lead to a recession? We don't know. But there are dark clouds that are appearing. So we're kind of heading into this next couple quarters into a path which is filled with dark clouds, and it's really going to be who's going to be coming out on the other side is the one that's going to benefit the most for when the recovery begins. So that's, with Fiverr, Upwork, Neo, for example, is a company that, again, Palantir and Neo, they have a lot of cash. They have plenty of cash. So there's little to no bankruptcy risk. And Neo also did announce that they're cutting jobs. 10% of their workforce is going to get cut. And why is the stock higher? Well, because that's what's going to help the company achieve profitability. I've been saying this for well over a year. Neo's got too much focus in too many different things. They should just focus on one thing and doing that one thing right, which is focus on profitability and just getting the company to positive cash flows and profitability, and then they can focus on other things and kind of diversify their business. But right now they're kind of like all over the place. So got it, 3.3% green. That's pretty good. Down 21% pre-market. I placed a limit order months ago at $47. Thoughts, anyone? So Ray, I did a video on Fortinet earlier today. Definitely do check that out if you want to learn more about my fair value, my intrinsic value, all that stuff is going to be included as part of the analysis over there. All right. So yeah, if you have any companies, any stocks you want me to go over, I'm happy to. Let me know. But of course, if we can keep it away from like some of the big tech, large cap stocks that we already talk about 24/7, I think that would be great. Think markets reverse to all-time highs from here, Caddy. So again, we need to break out certain levels before we can have any confidence or confirmation that we're possibly going back up to all-time highs. And that's going to be 4,400, 4,500 on the S&P. Nasdaq needs to break out over 14K. In order for us to see that momentum build up. But if you get rejected here, as we're coming up to this resistance test, and then roll right back down, so we're continuing on that downtrend. So, all right, let's see what we can look at. ARM Holdings, I did a video, when the IPO was happening, and the valuation, of course, was way too high I think still is. It is a profitable company, so that's good. $524 million of net income, 54 billion is where it's trading at the moment. So 54 divided by 0.25. Again, price earnings multiple is very, very high for the company. Price to book 12 times. So that again is, incredibly rich multiple, because 54 billion, if it were generating $1 billion, it would be 54 times earnings. But since it's doing, half that, 500 million, so we're looking at 100 times price earnings multiple on a 2022 basis. So, that's pretty expensive. Sales revenue is about 2.6 billion. So we take 51 divided by 2.6, looking at 19 times sales, almost 20 times sales. So yes, I mean, it's got lots of potential in the semiconductor ecosystem, but are you willing to pay 20 times sales and 100 times earnings? If the answer is yes, go crazy. If the answer is no, there's better opportunities and we got to wait for better prices. Qualcomm, yes, Qualcomm I will be doing a video on soon. It's on my to-do list to do a video and analysis on Qualcomm, because I think it's still one of the more undervalued opportunities in the market. It's now starting to rally quite a bit. Nice move to the upside. Resistance is going to be at closer to $124, $125. This is actually one of the first companies we did a stock report on. You can get a lot of these stock analysis and the reports published by us, and the link's going to be shared with you as part of the community access. So if you do join, that's going to be available. McDonald's increasing wages and menu prices in California. So wage increases is certainly going to increase cost, but that's almost fixed, right? But the prices going up certainly should help the revenue. But the demand is going to start to kind of maybe waver off a little bit. But again, McDonald's is kind of like a Coca-Cola brand where they have a lot of pricing power. And even if they do raise prices, they can, attract similar equivalent amount of demand futures. So it should keep the margins. The margins, it all comes down to how the revenue and the cost moves. If the revenue goes down faster than the cost, right, margins compress. If revenue goes up faster than the cost, margins expand. If they both go up or down at the same rate, margins stay the same. And with Tesla, the problem's been, for the longest time, they've been cutting prices faster than they've been witnessing cost cuts, right, on the cost side. That's why margins are going down. They're compressing. So, the same thing applies to individuals as well, right? When we look at our savings rate, how much do you save from your income? It all depends on your income and your expenses. And that determines your savings rate. And the next year when you get a raise, when your income increases, if your expenses increase at the same rate, then the savings rate stays the same. But our goal is to increase our income, decrease our expenses, so that we can increase our savings rate, or at least keep it high enough so that we're investing majority of that, right? A little bit of personal finance, but Caddy, understandably, you don't want to analyze big tech. Could you please do a quick analysis on Tesla on an intraday basis? Would be very helpful. What about Starbucks? Good for long term. So again, very good sort of pricing power for Starbucks as well. But let's take a quick look on Tesla here on the shorter time frame. So let's just start with the daily here first. So it does have a pretty significant gap that it needs to fill, right? After the earnings between 230 and 240s. So this right here, pretty solid gap for Tesla right over there, which may or may not eventually get filled. And resistance is going to be in the 240s for Tesla again. But right now you'll notice that we are coming up to a resistance already. It's going to be sitting right there at 222, 228. So that's exactly where we have gone rejected before. This was back in October 24th. Got rejected here once, twice, and sold right back down. So if you do get a breakout above that level, then the next resistance, is going to be all the way up to 227 to as much as 230s to kind of fill this gap for Tesla. It does kind of feel like it's making a little bit of an inverse head and shoulders on the 30-minute time frame. Left shoulder, head, a potential right shoulder, and then eventually we get a breakout. We'll see. All right. Let's see. Look at Enbridge Energy. ENB. New York Stock Exchange here. Okay, so oil and gas, looking at some traditional energy companies here. Revenue's been somewhat flat. Profitability has also been flat quarter over quarter. Pretty decent numbers because, again, oil prices are higher. And I'm kind of curious whether they do like liquid pipelines, gas distribution, storage, gas transmission, and midstream. Okay, so this is actually a midstream company in oil and gas. So there's downstream, midstream, upstream. I've done a video on a lot of these oil and gas companies in the past. We did not include ENB back then, but definitely do check that out. 7.7% yield is actually pretty good, and obviously very high given it's an energy company. But I'm assuming they have a lot of debt on the balance sheet, which is going to be very normal. So they have almost $60 billion worth of debt. That's net debt, right, after accounting for cash. And earnings are expected to be somewhat flat, not really grow. And take a look at cash flows. We're looking at pretty decent cash flows, on a quarter over quarter and even on a year over year basis. 7.2 billion. That's phenomenal, just given how strong the energy market has been. So from an energy standpoint, it is, again, pretty good, I would say, solid revenues and earnings. Debt is a big issue for the company. And just from a preliminary understanding, I would say the valuation is also going to be quite reasonable for this. Maybe, I guess, somewhat higher because the growth isn't really there. So 24 times earnings is certainly high. And 2 times sales, 6.3 times earnings, sales multiple for the company. XOM, on the other hand, operates both in the upstream and the downstream business. 10 times earnings multiple, 7 times sales, and a little over 7 times cash flow, a little over 1 time sales. The dividend yield, of course, is lower, 3.4, so half of ENB. But, of course, a lot of these companies have a lot of debt. Okay. Treasury bonds, should we start postponing? Postponing what, Edward? HSY, SMCI. So Supermicro will be doing an analysis on that. BX, don't know what that is. Blackstone. Okay. So consistent downtrend here, then started moving higher in this higher high and higher low pattern. So quite reasonable uptrend here, and it's possible that we do see some acceleration to the upside for Blackstone. Next resistance is going to be at 115. A very, very important level of resistance to watch for Blackstone over here. Is all buy here cool? So I sent out an alert. I picked up more shares. We'll most likely be buying a lot more. I should actually be buying a lot more already because the yield has just gone down, right? As the price goes up, yield goes down. It's gone from like 6.75. It's almost at 7% to 6% now. So it's done incredibly well, in the last few days. And I did pick up a lot of O. I think in the mid 40s. Kendall, thank you so much. I really appreciate you. Long-time Patreon member. Love your content. Thoughts on ChargePoint. So I did share my thoughts on ChargePoint yesterday. I'm happy to go over that again. By the way, guys, make sure that you drop a like. I would really appreciate it. And subscribe to the channel if you haven't already. And if you want to get access to a lot of the member benefits, TradingView charts, members-only private videos this weekend, I'm going to be posting 2 members-only private videos with technical updates on the FANG stocks and our refined trading strategy for swing trading only. So swing trading ideas and setups, and what precisely are we going to be looking for, setting out some parameters. And like I said, I mean, they're not going to trigger every single week, every single month. They are going to be higher quality setups, but with a very nice higher success rate. So we're not stressing ourselves over what to trade on this week or what to trade on next week, but we're looking at specific set of parameters. They do get hit. We know that the opportunity is going to be very, very good with low risk, high reward potentials at those prices. So again, if you want access to all of that, link's going to be down below. We'd love to have you on board, and I'm happy to go over individual stocks and a lot of macro stuff for all of you in the Discord as well. But yeah, when it comes to ChargePoint, I mean, these are companies that are heavily shorted, right? So yesterday's rally was strictly due to a short covering and the yields dropping. So two big reasons why we did see significant amount of gains for a lot of these companies. So, but it all comes down to profitability, right? It all comes down to, is ChargePoint one of those companies that's going to survive this downturn, right? From a balance sheet perspective, they do have more debt than cash. They are generating losses. They are generating negative cash flows. So how long can they go on for, right? That's another piece of analysis, which is called a cash burn rate. How much are they burning cash every single month, and how long do they have until they finally have to throw in the towel and be done? So we'll include that type of analysis as well in our future updates. It's a lot of data points, right? It's just a lot of data to look at. You can kind of look at it in different ways and make more sense of it. What will be the effect of Square earnings to PayPal? So let's take a look at PayPal here. Slightly down. Square definitely pushing higher. I haven't looked at Square earnings yet. I'll definitely see if I can do a video. They reported last night. So PayPal's not really moving all that much on Block's earnings. So I'll do a video on this company when I get the chance. I haven't looked at Square's numbers yet. Yeah, Nasdaq pulling back here a little bit. There we go. So yields continue to drop. We're down 2.8% now, just a little bit over 4.5%. But yes, the yields are the big reason the markets are pushing higher, but Nasdaq and S&P starting to roll over a little bit. But I wouldn't be surprised if we do see that momentum carry forward to close out a very strong week here for the market. So yeah, 90% probability now. The Federal Reserve. Oh wow. 1, 2, 3, 4. 4 rate cuts. The market's pricing in. This was at 3 before. So one additional rate cut. In other words, 100 basis points worth of cuts is what the market's pricing in, and they're pricing in that this is going to happen sooner. Before we were expecting June 2024 to be the timeline for when the rate cuts begin. Now we're expecting May to be the first cut. There we go. Market is very optimistic about a recession or softening in the labor market, I should say. So Florin, if you have any questions, if you have any stocks, let me know. I'm happy to go over that. What do you have? Albemarle. I'll go over that for you right now. It's just, there's too many comments, man. I'm trying my best to kind of keep up with everything. ALB. So let's take a look here. 1.2% dividend yield. Again, it's an energy company, right? So it depends a lot on the commodity prices, which is going to be oil and energy. And that's one of the things with a lot of these commodity stocks is that you have to really look at the pricing for the commodities, right? The underlying commodities that it tracks, because that is really what's going to dictate the revenues and the earnings and profitability, and eventually that's what's going to dictate the stock price. So you got a low dividend yield. We've got not that much growth in revenues or profitability, and we've got positive net debt with I guess decent cash flows, but they were negative until 2021. Just more recently they've started to turn positive. So I don't know. I may have to do more research on this to see if there's any positives, but just from the early analysis, it doesn't look like there's a lot that's interesting here. Because economy is good and no recession. Sean, random question. How do you ever think of joining the finance industry? It's just the hedge fund manager. It's just the working hours, man. The time freedom. To me, like having the time freedom is far more important than having financial freedom, and that's because time is the most valuable asset that anyone has, right? So having to work, like I've done that. I've not specifically in the finance industry, but I have worked 120 hours in a week or 100 hours. Like I used to work a lot of overtime, and it just went crazy. Like it wasn't something that I kept up with, lack of sleep and just poor health and lack of mental health and all that stuff. Like I've done that. I've been there, and it's not something that I want better work-life balance, and I want better time to spend with people that I really love and care about, and such as you guys, right? So you guys are like a second family to me, and also do things that are gonna have a positive experience on my well-being. So that's really where I think I need to focus on, rather than just like working my. I mean, I still do a lot of hours, but this is what I really love. So Pepsi, we'll take a look at. Okay, Pepsi, we can see. Now you work 100. I was just gonna say that I still do work a lot, but it doesn't feel like it, right? It doesn't feel like that at all, because I love it, and I love working with our community and coming up with these interesting analysis and research and whatnot. So, but yeah, I've done that before, and it was not super. It's not a happy place to be honest. And I am going to. It's gonna include it in our psychology of investing course that I'm working on. It's gonna be released soon, I promise. It's just taken me so long. But it's going to have a 40-minute video that goes over my story, right? So you'll learn who I am, because a lot of you guys know who I am, but you don't know who I was. And so that 40-minute video that goes over the story is going to tell you everything about my past and how I got into finance, how I got into investing, how I got into everything. Like, it's going to go over every little single detail about my life. And that's going to be a 40-minute video. So it's a longer video, but it should give you a very good understanding on who I am. Okay. I love everything about the community except for the orange juice gang. Yeah, feels less like work, more like progress. Couldn't agree more. That's very, very well said. So when do you expect to end phase to come up again? So rate cuts is really the main thesis there for when rate in phase could start to move back higher, because like I said, it's a discretionary product, and people are only going to spend on microinverters, solar systems, when they can finance it well and cheaply. So yeah, rate cuts is a very, very important aspect to Tesla and Enphase's earnings. For Pepsi, we got a support now sitting at 165. Very nice, momentum back up. It was oversold. It was trading at these, oversold levels for MACD and RSI. So we're seeing a very nice move back up. And the next resistance and target I would put down for Pepsi is going to be closer to 174. So 174, 175 is going to be that next level to watch for Pepsi. Yeah, it doesn't work when you're following your passion. Yeah, and I could get very philosophical here very quickly, but every person I meet, I basically tell them to go find something that you truly enjoy, truly love, because at the end of the day, that's what's going to keep your purpose intact, and it's going to keep you motivated. Because if you're doing things that you don't enjoy or don't want to do, like, sooner or later it's going to wear you down, like it did me, like 3 years of working, doing things that didn't really fulfill me. It's going to wear you down eventually. So the caddy I used to know used to rag on Tesla. Yeah, I mean, it took me a while to come around, but it's still a valuation concern. Like, I would still not shy away from the fact that valuation's high, it's expensive, and I would consider Tesla at 200 plus to be overvalued. But yeah, the overall business, and I still, mention it, that it's an electric vehicle company right now. It's not a tech company. I don't think it's a tech company right now, but eventually it has the potential to become a tech company for sure. So if IWM opens up at 173, we are in for a good ride. So let's take a look. But let's just shift back to the markets, okay? And this right here is actually a pretty good technical setup for IWM. 1.7% move to the upside, very nice, gain pre-market. It's got the potential to at least see a 15% move if rates continue to go down. So I think it's going to be, let's see, small cap. There's a levered ETF. I think TNA is that ticker symbol. There we go. Pushing up over 5%, 8% yesterday. This is actually, there's a lot of potential for this. So I may come up with a trade idea on IWM and might share this with all the members today. But this, from a swing trading perspective, has a lot of potential to the upside. It may already be a little too late, but there's still opportunity. The risk reward is not going to be that great as it was like a couple days ago, but I think there's still momentum. So we'll talk about that. Caddy's best call was Vertex 180 to 370. Best call so far. Thank you. Appreciate that. And I'd like to think that there's been more, but I think SMCI actually was one of those that we covered earlier this year, has just absolutely gone crazy. We talked about it in February when the stock was like at 70, or no, roughly around $80, $85 per share. It's gone up like 200%. And there was another one, Southern Copper. And there's been a lot, but of course there's been wrong calls as well, right? I mean, PayPal and Phase. Time will tell if they actually end up performing better, but you're right. And it's just how the markets goes, right? You can't be right 100% of the times. So ChargePoint, William, we already talked about. Fortinet, Paul, I did a video on Fortinet earlier today. So that should help you getting some understanding on what really happened. I mean, earnings guidance was pretty brutal. And not really brutal, but really slowing down on the growth rate. And that's such an interesting concept that we've talked about, is that when the earnings growth starts to slow down, even if the earnings themselves are growing, but the rate at which they're growing slows down, then that becomes a bit of a problem for Wall Street, and they start to ditch that stock. That's 2 earnings in a row. Fortinet has not provided great guidance, and they have sold off. So we are now coming down to a very nice sort of support here. That's where the demand is, but sub $40 is really what I would be looking for Fortinet. So Diana, feel like missed the opportunity to buy in last week. Now almost seemed like too late to buy into the rally. Do you see any more chance this month? Where will we get the same opportunity last week? So it really depends on the question that I'm about to ask you. Trading opportunities or investing opportunities? Are you looking to trade in the market, or basically take a swing trade or trade on the long side? Or are you looking for investing opportunities where you can dollar cost average and then hold for a longer term? So short term or long term is what I'm trying to get a good understanding on, whether you're looking to, again, trade in the short term or invest long term. You have to try Somewhere in Dubai Mall and thank me later. So good. What is that? Somewhere is like a fast food place or restaurant or something? I have never heard of that. Somewhere. That's the name of the place? What do they sell? So then midterm swing trade. So yeah, for that, I would say the opportunity is somewhat gone because, like I said, 3 days ago, the risk reward would have been best. Right now, we're already on our way up. We're coming up to that lower high. So right now, there's not going to be, in my opinion at least, not the best risk reward trade-off. But that doesn't mean the market's not going to give us opportunities in the future. And that's exactly what we're working on, right? With volatility, with our spreadsheets. I don't know if I have that open right now, but so let's see, volatility. There we go. So this right here, something that we are working on basically tells you where the VIX is, and what that percentile is. And we've added a few more things I will be going over. Some more things related to different parameters that I mentioned we will discuss in our members only private video later this week, right? On the weekend, I will talk about that in more detail so that we can better understand and take action for when the best opportunities come up. No love for Paycom. Yeah, I did a video on Paycom. It's a restaurant, so good, everyone lines up for it. Okay, I'll definitely check it out. It's about to get really busy here too. November, December, January, like those 3 months when the weather cools down. It's about to get really, really busy. That's what I've been told. So my plan for the next 3 months is to stay at home, not go out, save money, and that's it. That's the plan. But I'll definitely go check that restaurant out. Paycom, we did analysis on this yesterday or the day before. It did push higher yesterday, almost 8% move to the upside. So there's a massive gap to fill for Paycom, of course, over here. So we'll see if it actually does eventually come around. But I think the valuation is still a little too high right now. DocuSign, or no, DigitalOcean. So DocuSign is DOCU. DOCN is DigitalOcean. yeah, I mean, I'd be happy to take a look at this company. Seems like it is still not profitable, but almost going to turn the corner towards profitability. But of course, still making these lower highs at the moment, selling off pretty aggressively with a little bit of a falling wedge, I would say. So we'll take a look at this, pushing up over 25% right now on the back of looks like positive earnings beat and a revenue beat as well. So the next resistance is going to be closer to $30 for DigitalOcean right now. Anyway, so 3 more minutes left for the markets to open. So would you trade hermit mode? Would you trade Bitcoin, or do you think it's too much of a gamble? From an investment standpoint, I would still like have like maybe a small allocation towards Bitcoin, but no, I mean, it's just not the market that I would like to trade on a regular basis. So could you explain one thing? When there is a gap, is it only daytime frame what matters? Because often gaps are already filled in after hours or pre-market in, for example, 1 hour time frame or so. Yeah, so it's mostly daily is what we look for gaps, because pre-market and after hours liquidity is not a lot of retail or even institutional liquidity. I mean, there's the volumes are suppressed pre-market versus after hours. So really it's during the day, during the trading day is when we look at for actual liquidity and price action. Because there's more market participants, and that's what makes the market price more valuable than looking at it pre-market versus after hours. So those gaps, yes, we do look at them on a daily time frame for them to eventually get filled, which most of them do get filled. Some of them obviously don't. Yes, I'm a local. It will get so busy, but locals and Arabs will go in Riyadh for Riyadh season. Less traffic. Gotcha. That's yeah. I'm learning new things as I've moved here, so it's definitely been quite an interesting time. Same as New York, stay indoors. It's going to get cold. Yeah, it's going to get really cold over there for sure. But I do like the cold weather. So, all right. So 2 minutes left. Markets are still pushing higher. Nasdaq's up over 37 basis points. S&P continues to gain momentum, up over 61. And the Dow Jones, look at that. 1.87 for the Russell, and Dow is up over 0.64%. So IWM definitely now above 173, showing lots of signs of momentum here on the day. And of course, the yields continue to drop, 3% down, just over 4.5%. So TMF is 478, up 6%, very, very nicely. So lots of momentum coming in for these companies. So another video will be coming out shortly, going over the technicals of the market, and then we'll also talk about of course, the 4 to 5 areas to look at for when rates are actually coming down. What does green candle, red day mean, and vice versa? So green candle, red day simply means that the market price closed at a higher price compared to the previous close. But red candle basically means that intraday it's sold off. So it's a good indication of the price action intraday versus where the price closed. So, you know, if a stock gaps up, right, and is green on the day, but the candle is red, that means intraday there was a lot of profit taking, or there was a lot of selling pressure where the price action was weak from a bullish standpoint. So, and then vice versa, you know, if it gaps down, so it's down on the day, but a green candle means the price action was very strong. Buyers stepped in to push it back higher. So there was a lot of buying activity, even though it was down. So anyway, NASDAQ's open, S&P's open. So let's take a quick look. NASDAQ is up over 0.5% right now on the open, 13,350, and S&P's up about 0.5% as well, with the Dow Jones pushing up over 0.5%. Lots of individual stocks, of course, green on the day so far, with the yields dropping. And Apple is the only one that's down 2% on the day, with Tesla up over 1.4, back over 220s. And of course, Amazon, Nvidia, Netflix, AMD all pushing higher on the day today. So that's where we are, everyone. Thank you so much for joining. This was definitely a longer live stream on the back of unemployment numbers. Numbers came out. We came in a little bit softer at 150,000 jobs added, unemployment rate sitting at 3.9%, ticking higher by 0.1. Manufacturing losing significant amount of jobs compared to the consensus, 35,000 jobs lost. Participation rate did lower, 62.7%, and the unemployed persons increased to 6.5 million, with that ratio now sitting at under 1.5. So once again, thank you so much for joining. Really appreciate it. Make sure that you drop a like, subscribe to the channel, and links to our Discord. Patreon is going to be down below if you're interested in joining, and of course getting access to everything, including the members only private videos, intrinsic value spreadsheets, volatility cheat sheets. Lots of information, lots of data is going to be available with